XLM just broke below 20 cents. The RSI hit 26.2, deep oversold territory. The price is down almost 20% in the last 7 days alone. And in the middle of all of that, Stellar joined the OpenUSD Consortium, a new stablecoin initiative backed by Visa and BlackRock. The USDT stablecoin launched on Stellar's network, and tokenized real-world assets on Stellar surged 21.6% in 30 days, $2.83 billion. Stablecoin payment volume on the network just hit $5.5 billion. Developer engagement is at a record high. Those two things are happening simultaneously. The price chart looks like a disaster, and the network's actual usage metrics look like a network that's growing faster than it ever has. And that gap, the distance between what the price is doing and what the network is actually doing, is exactly the reason XLM holders who understand what they're holding don't need to sell. Let me be clear about what I mean by never have to sell. This isn't a promise that the price is going to some specific number. It's not a prediction. What it is the honest case that the specific architecture of what's being built on Stellar right now, the stablecoin settlement layer, the tokenized securities infrastructure, the regulatory clarity that just arrived, creates a situation where the value of your XLM position doesn't require you to time a sell perfectly. It doesn't require you to predict the top. It doesn't require you to trade in and out. It requires you to understand what you're actually holding and then leave it alone long enough for the institutional adoption that's already happening to show up in the price. Before we continue, if you enjoy this type of content, don't forget to subscribe to my channel. Now, let's get back to the topic. Let's start with what happened this week specifically, because I think the news from July 1st is actually the most important context for this entire conversation. Stellar became a launch partner in the OpenUSD Consortium. That consortium is a new stablecoin project backed by Visa, BlackRock, MasterCard, Stripe, and over 140 other companies. This is not a press release partnership where a logo gets added to a web page. This is Stellar being part of the foundational infrastructure layer for a stablecoin that some of the most significant financial institutions on the planet are building together. Simultaneously, a company called STBL launched USTT, a real-world asset-backed stablecoin, directly on Stellar's network. Encircle's cross-chain transfer protocol, which enables native USDC transfers, is expanding to Stellar. 3 stablecoin-related developments in a single day on a single network. XLM responded with a 10% rally in the hours after the announcements, before the broader market weakness pulled it back down alongside everything else. Now, here's something worth sitting with about that sequence. The price went up 10% on the announcement, then got dragged back down by the overall market. The announcement didn't go away. The OpenUSD Consortium membership didn't disappear when the price retraced. Visa and BlackRock didn't withdraw from the consortium because Bitcoin's price fell. What happened is that a genuinely significant institutional development occurred. The market briefly reflected it, and then the macro environment overwhelmed the specific signal. So that's the kind of temporary disconnection between event and price that creates the situations where holders who understand what they own have a structural advantage over traders who are just reading candles. And the development pipeline isn't sitting still. BitThumb, one of the largest South Korean exchanges, is halting XLM deposits and withdrawals on July 7th to support the upcoming Stellar network upgrade. This kind of exchange coordination for a network upgrade, where real trading infrastructure temporarily pauses, to accommodate a protocol change is exactly the kind of unglamorous operational detail that indicates how seriously an asset is being integrated into real trading infrastructure. Exchanges don't coordinate disruptions for protocols they consider marginal. Now, here's the thing I want you to actually sit with for a second. Stellar's stablecoin payment volume just hit $5.5 billion. That's not a projection. That's not a forecast. That's the actual volume of stablecoin payments moving across the Stellar network right now. $5.5 billion. And the tokenized real-world asset value sitting on Stellar crossed $2.83 billion, up 21.6% in 30 days. Those numbers are growing. The network is being used. Real money is moving through it at real volume right now. While the price of XLM sits at 18 cents in oversold territory, this is the setup that makes selling the most costly thing you can do. Not because the price is definitely going up tomorrow, but because the gap between what's actually happening on the network and what the price currently reflects doesn't close overnight. And every day you hold through this period is a day you're still in position when it does. Let me walk you through the structural reasons why one by one, because I think the individual pieces matter more when they're laid out separately than when they're bundled into a vague institutional adoption is coming narrative. First piece, the DTCC integration, and what XLM as the settlement token actually means. Back in May, DTCC, the Depository Trust and Clearing Corporation, the company that sits behind nearly every stock and bond trade in the United States and oversees roughly $114 trillion in assets, announced it's connecting its tokenized securities platform to Stellar. The target is live assets in the first half of 2027. But here's the detail that changes how you think about XLM specifically. XLM is designated as the settlement token for this infrastructure, not just one of the chains. They're considering not a possible platform, the settlement token. That's a direct mechanical link between the DTCC's tokenized securities volume and actual demand for XLM. When that infrastructure goes live and tokenized, the Russell 1000 stocks index ETFs, and U.S. Treasuries start settling through it. The entity executing those transactions needs XLM to pay for the transactions. That's not speculative. That's how the network's fee structure works. The question is purely about the volume of what settles and when it goes live, not about whether the demand mechanism exists. And it's worth understanding why DTCC specifically chose Stellar over every other competing network, because that choice wasn't random and it didn't happen overnight. DTCC acquired a company called SecCurrency back in 2023, and SecCurrency had already been working with Stellar's developers for years on exactly the kind of compliance tooling that a clearinghouse needs to have: clawback functionality, transfer restrictions, KYC controls baked into the base protocol layer. Those aren't flashy features. They're the boring, unglamorous details that determine whether a regulated institution can legally use a blockchain for security settlement without violating the rules their own regulators impose on them. The fact that Stellar had been building those features for years before DTCC needed them is part of why DTCC was able to move as quickly as it did once the decision was made. The groundwork existed. They didn't have to ask Stellar to build compliance features from scratch. For context on why this matters to your decision about selling, think about what it means for the price floor. Every tokenized security settling on Stellar's infrastructure creates XLM demand. It doesn't matter whether it's a bull market or a bear market when that happens. It doesn't matter whether Bitcoin is at $100,000 or at $50,000. Institutional settlement doesn't stop because sentiment is negative. Banks and clearinghouses run their infrastructure in all conditions. That's exactly the kind of demand that provides a genuine structural floor under the price that speculative demand never does. Because speculative demand evaporates the moment sentiment turns, while institutional settlement demand is operationally required regardless of sentiment. Second piece, regulatory clarity arrived in March, and the market hasn't priced it in yet. In March of this year, the SEC and CFTC jointly designated XLM as a digital commodity. That might sound like bureaucratic news, but for an institutional investor, it's the most important thing that could have happened. Commodity classification means custodians can hold XLM without legal ambiguity. It means regulated funds can include exposure to XLM in their products. It means Franklin Templeton's Benji Fund, which already runs on Stellar, operates from a firmer regulatory foundation. It means CME Group's XLM futures, expected later in 2026, have a cleaner legal basis to exist. The institutional gatekeepers that previously couldn't touch XLM because of regulatory uncertainty now can. And the price at 18 cents right now, with the RSI at 26, doesn't reflect that change having been priced in. It reflects a broad market sell-off, hitting a coin that was already in a recovery phase from its own correction. And the regulatory clarity sitting underneath it is still there, regardless of what the chart says this week. Third piece, Protocol 27 votes July 8th, 4 days from now. The Protocol 27 upgrade, called Zipper, is coming up for validator vote on July 8th. This upgrade is specifically targeted at improving the network's usability for complex, secure applications. One of its key additions is delegated authentication, the ability to assign transaction approval to other addresses, which is precisely the kind of enterprise-grade functionality that banks and institutional asset managers need before they'll build complex financial products on top of a network. Not because they think the technology isn't safe without it, but because their own compliance infrastructure requires them ability to delegate and control transaction authority in specific auditable ways. What Protocol 27 does for your XLM position isn't about the token going up on the day of the vote. It's about expanding the set of things institutional developers can build on this network. Every upgrade that makes the network more useful for the kinds of institutions currently choosing Stellar is another step toward a scenario where DTC scale volume, $5.5 billion stablecoin volumes, and $2.83 billion tokenized asset platforms get joined by the next wave of financial products that currently aren't buildable on this infrastructure. The network is actively expanding its institutional capability while the price chart has the community spooked. Fourth piece, the quantum preparedness plan is being implemented now. This one barely gets mentioned in mainstream XLM coverage, and I think it deserves more attention. Stellar is implementing support for NIST-approved quantum-safe signature algorithms in its Soroban smart contract layer. This allows enterprise wallets and custodians to migrate their signing credentials to quantum-resistant cryptography. Right. Now, ahead of a broader network upgrade, this is the kind of forward-looking infrastructure decision that regulated financial institutions specifically look for when evaluating platforms for long-term infrastructure commitment. A bank that's building tokenized securities infrastructure doesn't want to be on a network that's going to require emergency upgrades in 3 years because quantum computing threats materialized. Stellar is solving that problem proactively, and the institutions whose due diligence teams are evaluating the network are noticing, even if the retail market isn't paying attention yet. Fifth piece, the Meridian Conference is coming in Q3. The Stellar Development Foundation's annual Meridian Conference is scheduled for the third quarter of this year, designed specifically to build relationships with banks, asset managers, and global payment providers. It typically features significant partnership announcements and project launches. The same conference format has historically been where institutional relationships that eventually show up as deployment. Announcements got their initial public exposure. Whether this year's Meridian delivers something comparable to what Visa and BlackRock's partnerships eventually became for the network is unknown before it happens, but it's a known, upcoming, institutional-focused event on a near-term calendar that sits directly in the path of the timeline you're sitting through right now as a holder. So here's the actual shape of the case for never having to sell. You're holding an asset whose network is processing $5.5 billion of stablecoin volume, whose tokenized real-world assets grew 21% in 30 days to nearly $3 billion, which was just designated a digital commodity by both the SEC and the CFTC, which just joined Visa and BlackRock-backed stablecoin consortium, which has a DTCC tokenized security settlement. Integration coming in the first half of next year, with XLM designated as the settlement token, which is days away from a major protocol upgrade, which is implementing quantum-safe cryptography proactively, which has a major institutional partnership conference coming in Q3, and which is currently sitting at an RSI of 26, deep in oversold territory, with the price down 20% in a week, largely because Bitcoin fell and the broader market went risk off. The thesis isn't broken. The network is performing better than it ever has by almost every on-chain metric. The regulatory and institutional structure around the asset is stronger than it's ever been. The specific mechanism that connects network usage to token demand, the DTCC settlement designation, is more concrete than anything that existed 12 months ago when the price was higher. The price is down because the market is scared, not because anything about XLM specifically changed for the worse. And here's the last honest thing I want to say, because I think leaving this out would make this video dishonest. The never sell framing isn't literally about never selling under any circumstance forever. It's about selling for the right reasons instead of the wrong ones. The right reasons to sell are thesis changes. If DTCC walks back the Stellar integration, if the SEC reverses the commodity classification, if the stablecoin volume on the network starts collapsing rather than growing, if the SDF's 41% treasury wallet starts showing unusual out-of-pattern selling that indicates something has changed in the foundation's posture toward the market, those would be a thesis changes. And a thesis change would be a real reason to reassess your position selling, because the RSI is at 26 and the price is at 18 cents and the chart looks scary, is not a thesis change. It's a market condition. It's the kind of condition that the best entries in every bull cycle in history have happened during, not because price has to go up, but because the gap between what the network is doing and what the price reflects tends to close eventually. And it closes in the direction of what the network is actually doing, not in the direction of how scared the market was in July of 2024. If this kind of honest grounding in what's actually happening on the network, rather than just what the price chart is doing, is useful to you right now, go ahead and hit like. It genuinely helps more people who are sitting with the same question right now find this, instead of finding the version that just tells them to panic, or the version that pretends nothing is wrong. Subscribe if you want this level of detail on the XLM story going forward, because Protocol 27 votes in 4 days, and Meridian is coming in Q3, and the DTCC integration has a 2027 target, and each of those milestones is worth watching closely, rather than waiting for the next price candle to tell you how to feel. Drop a comment and tell me, after seeing the actual on-chain numbers, the 2.83 billion in tokenized RWAs, the 5.5 billion in stablecoin volume, the 7 institutions that have independently chosen Stellar's infrastructure in the past 12 months, does the price at 18 cents look like a network failing, or does it look like a market that hasn't caught up to a network succeeding? I want to hear how people are actually reading this gap. And if you know somebody who's about to sell their XLM because the chart looks bad, without ever once having looked at the actual network metrics sitting underneath it, send them this video before they do. Have a great day. If you enjoyed this video, don't forget to like, subscribe to the channel, and be sure to join my free Telegram community with the link on my channel, where I post my daily crypto experience and arbitrage opportunities you can't get anywhere else. This is XRP Hobart signing off.